Right now, somewhere in Australia, a renter is opening an email they've been dreading. $50 a week more, starting next month. That's $2,600 a year. Gone. Before a single grocery is bought, before a power bill is paid, before the month has even started. And here's the part that should make every Australian pay attention. The government modeled this outcome. They said the impact on rents would be less than $2 a week nationally. 3 independent research houses are now showing numbers that tell a completely different story. Today, I'm going to walk you through exactly what is happening to Australian rents right now, using real data from Domain, PropTrack, and CoreLogic. What caused it, why it's accelerating, and what it means specifically for you depending on whether you're renting, trying to buy, or holding investment property. Because the headline version of this story is missing the part that actually matters. Let's start with what the government said would happen, because understanding the promise makes the reality hit harder. When the federal government moved to restrict the full benefits of negative gearing and the capital gains tax discount to newly constructed properties rather than established ones, the stated goal was clear. Redirect investor capital toward new supply, increase construction, improve affordability over time. Treasury's modeling said the impact on rents would be modest, less than $2 a week nationally, spread across roughly a decade. $2 a week, manageable, almost trivial. But Australians have heard modest impact before. When the expanded 5% deposit scheme was rolled out, Treasury modeled a house price effect of around 0.6% over 6 years. Several markets moved 8 to 9% within months. Different policy, different conditions, but the same lesson. Forecasts tell you what might happen in theory. Real markets respond to changed incentives in ways that models consistently underestimate, especially when the market was already under stress before the policy landed, and Australia's rental market was already under stress. Then the policy landed. Now we have the real-world data, and 3 separate research houses, using completely different methodologies, are all pointing in the same direction. Let's start with Domain. In Sydney, median house rents jumped $50 a week in a single quarter. The median is now $850 a week. Median unit rents rose $30 in the same period to $780 a week. That is not a gradual drift. That is a sharp, sudden move concentrated into 3 months. And Domain's own analysis flagged something important. The jump coincided with investors moving early to protect cash flow as the tax changes became more certain. Landlords anticipating tighter margins pushed rents up before the policy even fully landed. Then PropTrack, which measures the same pressure at the national level. Advertised rents are up 6.4% over the past year nationally. In Perth, they are up 10.3%. Hobart, 9.1%. Darwin, 7.7%. Across the combined capital cities, rents are sitting approximately $40 a week higher than they were 12 months ago. And then CoreLogic, which captures the longer arc and makes the acceleration impossible to dismiss. National rents rose 1.6% in the June quarter alone. Over the full year, 5.9%. The national median rent has now pushed to $675 a week. But the number that really puts this in context is the 5-year comparison. Over the past 5 years, Australian rents have surged 40.6%. In the 5 years before that, the total increase was $55 a week, combined, for the entire 5-year period. That is the difference between a normal rental cycle and what we are currently inside. And when you translate those numbers into household reality, the picture becomes genuinely confronting. 5 years ago, Australian renters were spending approximately 27% of their household income on rent. Today, that figure has climbed to roughly 1/3. In many regional markets, it's worse. Renters spending more than 35% of gross income just to maintain a roof. The benchmark for housing stress is 30% of income. A growing number of Australian renters have crossed that line and are no longer approaching it. They are living it every single week. So why is this happening so fast? Supply. And the numbers here are stark. National rental listings are sitting 16.7% below the 5-year average. In Sydney, they are down 24.1%. Melbourne down 18.4%. Darwin down more than 26%. The national vacancy rate sits at approximately 1.6%. Adelaide is closer to 1%. For reference, a balanced rental market typically operates with a vacancy rate between 3 and 4%. Here's what a 1% vacancy rate actually means for a renter in practical terms. If you say no to a rent increase, your landlord has 10 other applications on file. You have almost no negotiating power. None. And both you and the landlord know it. That is the environment every Australian renter is currently navigating. Now here's the myth bust that most housing commentary never addresses directly. People ask whether the negative gearing changes caused the rent increases. The honest answer is more complicated than either side of that debate wants to acknowledge. Negative gearing has always acted as a buffer in the investment market. It allowed landlords to absorb weaker cash flow because the tax system offset part of the shortfall. When that buffer becomes less valuable, particularly for established properties, some landlords have fewer tools to absorb cost increases without passing them to tenants. In a well-supplied rental market, landlords have limited ability to do that. Competition constrains pricing. But in a market where listings are 24% below average and vacancy rates are near record lows, landlords are not operating in a competitive market. They are operating in a seller's market. And in a seller's market, costs get passed on. That doesn't mean every rent increase in Australia right now can be directly traced to one policy change. It cannot. Interest rates matter. Record net migration, adding 500,000 people to the population in the past year, matters. Construction bottlenecks matter. Insurance, council rates, land tax, and broad inflation all matter. But what the data shows clearly is this. You reduced investor incentives in a market that already had critically low vacancy rates and critically low listing volumes. And the pressure that resulted didn't evaporate. It transferred directly onto renters in real dollars every single week. That is not a Treasury model. That is what Domain, PropTrack, and CoreLogic are showing simultaneously. Now the question everyone wants answered. Is this temporary? The theory behind the reform has internal logic. If investors redirect capital toward new construction rather than established properties, new supply eventually comes online, vacancy rates normalize, and rental pressure eases over time. That theory is not irrational. On a long enough timeline, it could work. The problem is time. And Australia doesn't have the supply position to absorb a transition period comfortably. The country is currently estimated to be approximately 300,000 homes short of what is needed. The federal government's target to build 1.2 million new homes by 2029 is already considered by most industry groups to be unachievable at current construction rates. Labor shortages haven't resolved. Approval timelines haven't shortened meaningfully. Construction costs remain elevated relative to pre-pandemic levels. New supply does not arrive quickly. A policy change designed to stimulate new construction takes years to flow through into completed dwellings. Meanwhile, Australia continues to add population at a pace that keeps demand ahead of supply every single month. So even if the long-run policy logic is sound, and that remains debated, the short to medium-term reality is that more Australians are spending more of their income on rent, with less capacity to push back, in a market with fewer options than at almost any point in recent memory. That's what people are living with right now. So what does this mean for you specifically? If you're renting in Australia right now, the honest assessment is uncomfortable. Bargaining power is almost entirely on the landlord's side in the current market. If rents continue rising faster than wages, which they have been for 3 consecutive years, the decision many renters face is not whether to pay more, it's what to sacrifice to do so. A longer commute, less space, sharing when you'd rather not, moving away from family, schools, or work. None of those are good options, but they're the realistic ones in a 1.6% vacancy market. If you're trying to buy your first home, the rental crisis actually changes the calculus in a specific way most first home buyers don't think about clearly enough. Every month you remain renting in this market is a month you're paying someone else's mortgage at increasingly elevated rates. The traditional advice to wait and save a bigger deposit assumes that rents stay stable while you save. That assumption has not held for 3 years running, and there's no credible evidence it will hold for the next 3. That doesn't mean rushing into a bad purchase. It means that the cost of waiting is now significantly higher than it was, and that calculation needs to be part of your decision framework. A mortgage is not a bet on the next 6 months. It's a 25 to 30-year decision. Through that window, governments change policy, interest rates rise and fall, and sentiment swings in both directions. The underlying force that persists through all of that in Australia is the same one it has always been. The country has a structural tendency to add people faster than it adds homes. And in markets where supply is persistently constrained, The people who acted decisively on the right property at the right price have historically been better positioned than the people who waited for conditions to improve. If you're an investor holding established residential property, the picture is uncomfortable in some ways and reassuring in others. The tax changes reduce the buffer that negative gearing provided. That's real, and it affects cash flow for investors with larger mortgages or lower-yielding properties in particular. But the same supply shortage that is pushing rents upward is also providing price support for established properties in well-located markets. The vacancy rate that gives tenants almost no negotiating power is simultaneously giving landlords almost complete pricing authority. The gross rental yields that looked thin 3 years ago look substantially better in a market where rents have risen 40% in 5 years. The medium to long-term investment case for quality property in supply-constrained Australian markets has not weakened because of a policy change. It has strengthened because of a structural shortage that policy changes alone cannot quickly resolve. So here's the single most important thing to understand about what is happening in Australian housing right now. This is not primarily a story about one government announcement. It is not primarily a story about one Treasury model being wrong. And it is not primarily a story about Sydney. It is a story about what happens when you change incentives in a market that already had almost no capacity to absorb additional pressure. The pressure doesn't disappear. It gets transferred. And right now, a disproportionate share of that transferred pressure is landing on renters, the group with the least power to push back and the least financial buffer to absorb it. That's the honest picture. And Australians deserve to see it clearly. If this gave you a clearer understanding of what is actually driving Australia's rental crisis, hit the like button and subscribe. Turn on notifications so you don't miss the next breakdown. I'll see you there.